I'm Evan Polaski, Managing Director of Investor Relations with Ashcroft Capital. And back with us today is Scott Lebenhart, Ashcroft Capital's Chief Investment Officer. Today, we really want to touch on kind of a Q4 recap and a Q1 outlook for our future acquisitions and past acquisitions. So we'll jump right into it. Thank you for joining us today, Scott.
Yeah, thanks for having me, Evan.
Very, very grateful to have your time and share some of your insights with our investors. So why don't we start with Q4 and really a look back at what we bought, how many deals we had underwritten throughout that quarter, LOIs issued, kind of just what the acquisition pipeline looked like in Q4.
Yeah, absolutely. And given the volatility in the market, the pipeline significantly decreased from kind of where we were Q4 2021. I mean, that was a very robust period. We closed 7 deals in the fourth quarter of 2021. In 2022, in the fourth quarter, we closed 2 deals that we're extremely excited about. We were able to buy them and target. These were deals that we targeted specifically for certain reasons. We closed on Halston Paces Crossing in November. This deal is in Atlanta. It was a loan assumption deal with a fixed interest rate at 3.25%. So it was over 200 basis points lower than current rates. We know the submarket of where it is right now. It was the 4th property we purchased in Gwinnett County in Atlanta. Early 2000 construction, so great quality property. We were excited to be able to get that one done. And then we closed Midtown 501 right before the holidays. That deal is in Chapel Hill. It is an A++ location, very minimal deferred maintenance, light value add strategy, but tons of operational upside. It's a deal that was owned by a group that we worked with several times in the past. We bought several deals from before, and so we know how they operate, and we know how we can improve value off the get-go. So those are 2 fantastic deals that we were able to get our hands on and make sense and find a meeting of the minds at the right price, or what we believe to be the right price. But overall, it was much slower. We underwrote about 50 deals in Q4. That's probably about 50% of the deals that crossed our desk. And of deals that we were actually pursuing, we only submitted 7 LOIs in the fourth quarter, and that's dating back to where we would submit 7 LOIs in a week, based on some of the heavy volume that we saw over the past couple of years. So definitely slowing down there in the market, but we're still able to find the right deals and find the sellers that are willing to sell at today's pricing.
Looking back at Q4, kind of not only the deals that we acquired, but even the deals that we were underwriting, LOIs issued, how were we finding those deals? Were those mostly off market? Was it a balance of off market, on market? What efforts were we making on that front?
Yeah, it was a balance. And at the end of the day, we always say real estate is a relationship business. And we try to position ourselves to be the group that people want to work with and want to sell their deals to. And so that really came to fruition in the fourth quarter, and having that reputation and level of trust that will actually get the deals done. Paces Crossing was a true off-market deal that we were able to kind of get a look at it from a seller that we knew wanted to sell, sell out of certain deals in their portfolio. They bought the deal in 2018, refinanced out of it in 2021, or refinanced out their equity in 2021, which kind of gave us the ability to assume, a 2021 loan on it, with still a lot of interest only remaining on it as well. So we were able to convince them to sell at a price that made sense for us, just because they were looking to, they didn't know where the world was going, and they said, we're done with this one and we'll move on. Midtown 501 was a deal that was marketed. However, like I said, we bought 2 other deals previously from the seller. We know them well. We were able to kind of negotiate with them directly, and given the level of comfort that they had with us, they wanted to close before the end of the year. We wanted to close before the end of the year to allow investors to benefit certain potential tax advantages. And so we were able to get the the seller comfortable with moving forward with us at a discounted price to where some of the other groups were. But we're continuing to have conversations with groups that we know and try to pry some deals away from them. But a lot of it's, we're doing intense amounts of research right now. We did a lot of research back in Q4 where we're targeting specific deals and specific locations that we want to be in and quality of deals that we want. And we have our databases where we're able to search when deals were purchased, what type of loan structures are on those. And those are the deals where we're approaching sellers and saying, hey, we know you bought this in 2018. You have your debt maturing next year, et cetera, et cetera. And for people that bought then, even though the market's in some turmoil right now, they're still making money on their deals, and perhaps incentivizing them or being able to negotiate that, we're the right buyers for it. We'll make it nice and smooth. And so we're doing a lot of targeted approaches on our deals to drum up, deals off market right now.
In terms of actual, deals themselves, you talked about that we're targeting a much more specific type on the research front with various funds, but are there changes in general focus of like the type of risk profile or anything along those lines that we're looking at today, kind of Q4 and starting to blend into future looks or looking forward as well, relative to say end of 2021, early 2022?
Yeah, I'd say it's just more of a narrowed focus where, certain quality of deals make a lot of sense right now versus others. Loan assumptions make a lot of sense because it takes one of the most uncertain and volatile components out of the deal, out of the equation, by having a in-place loan that you can assume. In terms of the types of targeted deals that like the specific deals right now, lighter value add deals make a lot of sense with limited deferred maintenance. Historically, in the beginning of 2022 and beyond, there was plentiful debt out there that was willing to fund future CapEx projects, et cetera. Right now, it's selective, and we're able to lean on some of our relationship lenders for loans like that. But if you're going with an agency loan or some type of fixed rate product, the cost of that deferred maintenance, the cost of the renovation, that's coming out of equity. And that is obviously more expensive than debt, which is why people put debt on their property. And so that's draining the ability to print some decent returns on certain deals. So deals like that are more targeted, that are in great shape, that's not super heavy lift. Right now, again, we've made a lot of great acquisitions in the past that are heavy lifts, but right now the environment is not conducive to that. And we're also really focused, like we talked about before, the potential of a recession in 2023. We're looking at, recession resistant locations, looking for good schools, great access, stable, diverse employment drivers in the area. So that's another factor that we're really focused in on, at the moment.
Everything Mark noted in terms of how we're sourcing deals, types of deals that we kind of were focusing on both Q4 and forward, how do we see that continue to evolve, or what areas are we really focusing on maybe a little more heavily given the information we've received over the last 3 months?
Yeah, I mean, I think in Q1, we're going to still continue to be extremely selective on the deals that we're targeting. From an acquisition projection, we unfortunately expect limited transactions to still occur in the first half of 2021. 2023. These years just keep going. We're going to continue to be disciplined and make sure we're buying the right deals at the right price. And a lot of that goes into again, what I was talking about in Q4, how we're targeting specific deals in specific locations. That's going to be where we continue to focus in on, and also really continue to have the conversations with the groups and the potential sellers out there that we've worked with in the past in order to try to pry some deals away from them. Later in the year, towards the second half of 2023, We do expect there to be some more transactions. We expect there to be some deals that do happen in Q1, which help create data points for us out there, which will hopefully help the bid-ask spread become a little more narrow, and people starting to realize, hey, this is what a 1990 vintage deal in this location is being sold for. This is what market pricing is for it. Hopefully there'll be some more stabilization in the debt markets. The belief is that by mid-year, rate increases will come to a halt, and even potentially by the end of the year start to decrease. So there should be more clarity on that front. And we also believe, towards the end of this year, there'll be some more distress in the market, that we're going to see sellers that do have debt maturities coming up, do have rate cap purchase obligations to fulfill, and just cash flow being drained from properties based on higher than expected debt service. We expect those deals to start to come out in the second half of the year. So right now it's a lot of positioning with the groups that we believe will have those opportunities for us throughout the year, and really staying true and making sure we're buying safe, conservative deals in really strong locations.
But how are we then, making sure that we're not in a similar pinch, if rates don't drop like they're supposed to or anticipated in the next few years? How are we adjusting our financing structure and overall just kind of deal structure accordingly?
Yeah, and a lot of that's being proactive. With our existing deals, we're being extremely proactive. We're having conversations with lenders today. Actually just double checked a couple of weeks ago, because we knew that there were no loans maturing in 2023, and that was just triple checked just the other day to make sure we didn't miss anything. So we have no loans maturing this year, which is fantastic. We have no guns to our head. We have no reason that we need to sell deals. May we want to sell a couple of deals this year? Absolutely, but those are probably at deals that we have already been able to implement our value add strategy throughout. So it's not going to be a deal that we bought 6 months ago that we're looking to sell out of this year. But we're having conversations with lenders in terms of rate cap, future rate cap obligations that we have. We are extremely focused, as always, on operations, and making sure that our expenses are in line with where they should be and not running up. We are focused on maintaining extremely strong occupancy. On the construction side, we still are seeing plenty of demand for our renovated product, and our renovated units and our properties that we're really repositioning in the market. We're still getting, in a recession, there's usually a sense of some sort of flight to quality where people with stronger AMI, which is the markets that we've been buying, tend to like to live in those quality locations at perhaps a slight discount to where they would have been, at a stronger economic time. So again, we're focused on a lot of that right now.
Appreciate all your input, and I'll leave it if you have any other closing remarks that you'd like to add before we part ways.
Yeah, no, just it'll be an interesting year in 2023. As I think the world has a lot of sorting out, post-COVID. Well, I guess we're still technically in COVID. But hopefully supply chain issues figure itself out. The inflation, it seems to be like we're starting to get under control, and trending in the right direction. So hopefully this is last year was a tale of two halves, where the first half was all rosy and the second half was, I have no idea what's happening. We saw that after COVID in 2020, tons of uncertainty, obviously, for different reasons. But we really relied on our relationships. In the summer of 2020, we closed 3 deals at the end of 2020 that we were able to tie up throughout all that uncertainty, potentially some of the better deals that we've done. But ultimately, they were deals that we were able to buy from groups that knew us, that felt comfortable selling to us, knew that we would execute and close. And so, we expect this to be similar to that period of time where people are going to want to de-risk themselves on the sales process as well. And we're just looking to put ourselves in position. And so beginning of 2023, continued uncertainty. Hopefully we have some more clarity by the end of 2023. And we're excited to see what the year has in hold for us. We're awaiting some more surprises. So we'll see.
I think over the last 2 years, I guess almost three now, 2020 through to 2022, it's, if nothing else is certain, there's going to be uncertainty, is the only certain. So no, appreciate all your time and insights. And as always, grateful for you to share your thoughts with us.
Great.
Thanks
I
so much.
appreciate you having me. Thanks, Evan.